Threes are wild. Dow triple-digit gains again on three key factors: better than expected consumer spending report, optimism about Federal Reserve Chairman Ben Bernanke's comments on the economy, and indications the economic damage from Hurricane Irene was not as bad as many feared. So are the conditions now right for investors to send stocks even higher? For that, we welcome James Frischling, president and co-founder of New Oak Capital, and Wayne Rogers, founder and CEO of Wayne Rogers and Company. James, to you first in studio. So we're building on a week of gains, the first week of stock gains in some 4 weeks last week. Have we reached a turning point?
Well, I think we're going to continue to see a fair amount of volatility. So I am constructive on this market, and I want to define that means I do feel there are a lack of places to deploy capital right now. So blue chip companies, dividend-paying companies, and the equity markets represent a real good opportunity. I think you're carrying over from some positive sentiment at the very end of last week with Bernanke. I think we had no bad news out of Europe, and then obviously, as you mentioned, we had a less than damaging hurricane. We had good consumer spending this morning, and I think that has provided at least a little bit of a bid to this market, which we saw this morning and all day long.
Wayne, you know, the volume very low, and that makes sense coming off the type of weekend that we had. But don't you think this is a little bit of a bounce after this 3-week stretch where we had this correction, and there's still a lot of nervousness about jumping in headlong into this market?
Well, I think there may be a lot of nervousness, but I don't think it's warranted. I mean, the fundamentals are very strong. The fundamentals were strong then. 3 weeks ago, I said just before that, or just after that 500-point drop, I was on with Bill O'Reilly, and I said this is a great buying opportunity. I mean, American business is flush with cash. You see low price earning multiples right now. I mean, you talked about Ford earlier on General Motors. Ford is trading at less than 6 times earnings. I mean, and they didn't take TARP money, for goodness sake. So I think there are a lot of great companies out there, great buys, and I think that we're off and running. And that crisis that we had was a crisis of confidence, and it had nothing to do with the reality of the underlying stocks.
But outside of the spending numbers, which were surprisingly good, Wayne, the economy in a lot of sectors is still in real rough shape.
I disagree. The economy is rough in 2 places: jobs and housing.
And manufacturing?
And that's what, well, not really. It didn't. No, I by the way, sit on the board of a company, which will go nameless, in which we are manufacturing, and we are doing great. We've had the second best year in the history of the company. We are flush with cash. We're generating more cash all of the time. We are selling, as a matter of fact, our stock happens to be selling at a little less than 2.5 times the amount of cash that's in the company per share. So you got to say, with companies this strong, their balance sheets are strong and all of that, this is a momentary thing when people got crazy about this. And, of course, it is going to be volatile. Of course, you've got traders trading like crazy in this market, too.
But, James,
that is not the underlying reality.
James, to Wayne's point, we had a crisis of confidence when we have unemployment at 9% plus, and we're going to get a jobs report that isn't going to be great. I mean, many economists are thinking we're going to get about 80,000 jobs added to payrolls this Friday. That's going to continue to weigh on confidence. And certainly so many people look at the value of their homes as their most important investment. That's going to weigh on confidence too. That crisis of confidence isn't going away.
And I agree with Wayne's point about strong corporate earnings and the rebuilding of balance sheets. But he also highlighted the 2 biggest threats or the 2 biggest challenges are, just as you said, jobs and the housing market. What I found interesting was both Chairman Bernanke and IMF Chief Lagarde brought up U.S. housing. Bernanke from a standpoint of there's not enough growth in the U.S. economy to put people back to work with a somewhat gridlocked and sidelined housing market. I think IMF Chief Lagarde brought up the U.S. housing market specifically because if you think about how much risk globally is tied to the U.S. housing market, all the securitized products, all the structured products, all the mortgage products that are now linked to the U.S. market, and that exposure is global. So the 2 risks that Wayne was highlighting are very serious headwinds for this economy. Plus, I think Europe is going to continue to be a story that plays. Right now, it's slightly positive with some Greek bank mergers and quiet period, but that story is still not played out, and that, I think, represents a real threat. What's
the best risk profile for an average investor?
For an average investor right now, I mean, I'll twofold. One, to answer your question specifically, I think Wayne brought up fear, and I think people should try to calm it down. And if you see companies that you like, you see companies that have moats around their businesses, have global distribution channels, you know they have a franchise. If you see an opportunity like we had maybe with a strong sell-off over the last couple of weeks to rebalance a portfolio, I think that's a great play. A lot of the work we're doing is in the private space, private transactions, in part because the banks are not doing as much lending. So So I can't talk specifically about transactions or risk losing exemption, but the fact is there is a lot of money on the sideline that's looking to be deployed. And with the banks not being the proactive one, there's global real estate plays. There's a lot of asset-based financing opportunities, and there is capital looking to get put to work.
Wayne, as far as timing this market, do you just tell people, look, if you like companies on any type of a pullback, if you like these stocks, start to buy in a little bit, or do you wait for some type of an additional catalyst now into the future? We might not get one until the FOMC meets again on, I guess, the 20th and 21st of September.
I don't think you wait for anything. I think if you have a good company, sound earnings, solid balance sheet, you invest in that company. Now, you might invest, buy 100 shares now, and then a week from now, another 100 shares, a week from now, 100. You're not trying to time the market. I was fortunate in the sense that I said that this thing was a crisis of fear, and I went in and bought heavily during that when it took that big drop. Okay, am I a genius? No. I'm just another guy out there looking at reality saying, hey, this isn't real. This is something and traders are pouncing on it and driving it worse and making it more volatile. But that's a time, so you get in, you buy some, then you buy some more. Now, today the market went up. I might back out of the market for a while now and say, okay, let me see. Another drop, I'll buy some more.
All right, James Frischling, Wayne Rogers, thank you, gentlemen. We appreciate it. As always, good seeing you.